Welcome to our channel. How to get rid of a car when you have negative equity. Car ownership can be a daunting task, especially when you're struggling with negative equity. Imagine being stuck with a car loan balance that's higher than your car's current market value. Don't feel alone, it's not uncommon, especially in today's market pre-pandemic when car prices were hiked due to supply chain issues. This can also happen due to rapid depreciation or high-interest loans, leaving many car owners feeling lost and unsure of what to do next. For instance, let's say you bought a brand new car for $30,000 with a high-interest loan. After a year, the car's value has depreciated to $20,000, but you still owe $25,000 on the loan. This is a classic case of negative equity. Understanding your options is key to getting rid of a car with negative equity. Ignoring the problem can lead to more financial stress, as you might continue paying off a loan for a car worth much less than you owe. It's essential to explore selling, trading, or even voluntary repossession. Each option has its own effects, so being informed helps you make the best choice for your finances. In this discussion, we'll provide a comprehensive overview of how to handle negative equity. We will outline steps you can take, the pros and cons of each option, and valuable tips to minimize your losses. By the end of this video, you'll have a clear understanding of how to move forward and take control of your finances. Let's dive in and explore strategies for dealing with negative equity. Understanding negative equity. Negative equity is a situation where you owe more on your car loan than your car is worth. If you sell or trade in your vehicle, you'll still owe money, a frustrating reality that can limit your choices as a car owner. Several common reasons lead to negative equity. For instance, depreciation starts as soon as you drive off the lot. New cars can lose up to 20% of their value in the first year alone. High-interest loans and long loan terms can slow down equity buildup. Other factors, like buying a less popular model or making a small down payment, can also contribute to negative equity. Selling a car with negative equity can create significant financial strain. You might have to pay the difference between the sale price and the loan balance out of pocket, a daunting task, especially if you're facing other financial issues. One way to deal with this issue is to pay an additional amount besides the monthly amount. Most banks will accept payments directly to the principal balance to help to reduce the interest paid on the loan over time. An example of this would be a regular car payment being $500 but paying an additional $100 towards the principal payment. This will help to reduce some of the negative equity over time. Assessing your car's value. Knowing your car's current market value is critical when dealing with negative equity. This knowledge helps you decide whether to sell or trade it in. Use online tools like Kelley Blue Book or Edmunds to assess your car's value. Enter details like make, model, year, and mileage to get an estimated market value. Consider factors that can impact your car's value beyond just the basic details. Mileage matters. Generally, lower mileage means higher value. The condition of your vehicle, mechanical and cosmetic, also affects its worth. In some cases, when trading or selling, a best practice is to detail the car before presenting it to the buyer or dealer. A well-maintained and clean car can fetch a better price. Market demand can also influence value. Some makes and models are more desirable at times. For instance, electric vehicles currently in high demand, which can increase their resale value. Popular mechanical reliable brands such as Honda or Toyota might also be able to fetch a higher premium. If you're unsure about your car's value after using online tools, consider getting a professional appraisal. An expert can give you a more accurate assessment based on current market trends and your vehicle's condition. This is particularly helpful if you're looking to sell or trade in your car. Exploring selling options. When dealing with negative equity, it's vital to explore your selling options. You can choose between private sales and trade-ins at dealerships. Selling privately often yields a higher price since you set your own asking price and negotiate directly with buyers. However, this route can be time-consuming and may require extra work in advertising and paperwork. Trade-ins at dealerships offer more convenience. While you might get a lower offer, the dealership handles paperwork and applies the trade-in value directly to your new vehicle purchase. You can also sell to a car buying service. These services are popular for their convenience. They often provide a quick appraisal and an immediate cash offer. This option saves time and effort, but it's wise to compare offers since they may not always provide the best price. Each selling option has its pros and cons. Private sales can bring higher profits but require more effort. Trade-ins are convenient but may result in lower sale prices. Selling to a car buying service is quick and easy, but ensure you're getting a fair offer. By weighing these options, you can choose the best path for selling your car while managing negative equity. Negotiating with lenders. Effective communication with your lender is essential when dealing with negative equity. Start by reaching out and discussing your situation. Lenders are often willing to help borrowers who are proactive about their financial issues. By explaining your circumstances, you may find solutions or alternatives you hadn't considered. Being honest about your financial situation can lead to better negotiations. One option to explore is rolling your negative equity into a new loan. This means the amount you owe on your current car can be added to your new loan when you buy a new vehicle. While this avoids a large upfront payment, it may lead to higher monthly payments and a longer loan term, so weigh the long-term impacts carefully. Before negotiating, know your current loan terms. Understand your interest rate, remaining balance, and any penalties for early repayment. This knowledge empowers you during discussions with your lender. Having clear financial goals will guide your negotiation strategy. By approaching your lender confidently and informed, you can navigate the complexities of negative equity. Considering alternatives. When facing negative equity, consider alternative solutions to ease financial stress. One option is refinancing or loan modification. Refinancing involves taking out a new loan to pay off your existing one, ideally at a lower interest rate. This can lower your monthly payments. A loan modification means negotiating with your lender to change your existing loan terms, like extending the repayment period or reducing the interest rate. Both options can help regain control over your finances, but evaluate the long-term effects carefully. Another alternative is leasing instead of buying. Leasing usually requires a lower down payment and offers lower monthly payments compared to purchasing. This can help you avoid negative equity. However, remember that leasing means you won't own the vehicle at the end of the term, and there may be mileage limits and other restrictions. Please be cautious with this option, especially if you need to drive above average mileage per year for business or personal use. Standard mileage runs from 12,000 to 15,000 miles. If you know you will exceed this limit, either pay up front for the additional miles or prepare to pay for the additional miles at the end of the lease term. As you consider these alternatives, weigh the pros and cons of each option. Refinancing or modifying your loan can provide immediate relief but may extend your debt. Leasing can offer lower payments but may not fit everyone's needs. By evaluating these alternatives, you can make informed choices that align with your financial goals and help you navigate negative equity. You may want to get rid of your car with negative equity because you have your eyes set on a shiny new model, or you just have a genuine need to upgrade for space with a larger automobile. Whatever your reasons are, this is understandable and encouraged by dealerships across the country because it puts you in a weak bargaining position. A weaker bargaining position means more profit for the dealership. But, have no fear, you can still be in the driver's seat even in this scenario with additional knowledge on how to negotiate when at a dealership. Please subscribe to our channel and view our video library on how to negotiate your next car deal. Watch this next video.